The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
What I just want to do now is just to focus the attention on the more recent price action to just further highlight the application of the Elliott wave theory to get a clearer picture in terms of what we might be dealing with. Now, what I've initially highlighted are the two key turning points where the market reacted off the low, pulled back. That pullback failed to break the former low over here, and then the market started to move in an upward direction. If we can identify the first two swings, we can potentially label these wave one and wave two in terms of the pullback. Remember, the reason that we are now counting a 5-wave sequence up is because as part of the correction, the current trend is up. That is very important that you establish what the current direction will be to determine the direction of the impulse. I have also identified either an OR A or an OR B. We'll come back to that very shortly. If we focus our attention on this first swing being wave one, pullback being wave two, then this move up here is potentially wave three. Now, everything has a question mark because nothing is confirmed until it is ultimately confirmed. There are always a number of possibilities in markets, and it is very good to approach the market this way because hopefully that means that you'll be better placed to be prepared for any eventuality. If that is wave three, then let's see if we can identify a 5-wave sequence within wave three. You can clearly see that that 5-wave move higher has developed. At the time of drawing up this chart, we weren't sure whether the current levels would ultimately dictate the high or whether the market would continue to pull higher. Nevertheless, that represented wave 5 of this 5-wave sequence higher. We know now, over the last few weeks, price action did indeed push higher and has then found a resistance. So, the point to really also take home from this example is that this 5-wave impulsive sequence is the repetitive wave structure that keeps on repeating itself. There is no other count to the wave structure other than a 5-wave impulse. Don't reinvent or come up with your own theory and come up with 7 waves or 16 waves or whatever the case is. The structure needs to be evaluated and analyzed around a 5-wave structure. If this is wave 5 up here, and also then wave 3. That means that at some point the resistance will pull back, and that pullback will then potentially be wave 4, with the ultimate move to the top side marking wave 5. Now, once we've completed a 5-wave sequence, then the question will be, has that completed wave A? However, there is also another possibility that the high that we might see on this 5-wave sequence counted in red might then also mark the conclusion of wave A. We just don't know. It is important to be aware of these scenarios. And that would be because if this move higher is instead wave A, and that is wave B, then this 5-wave sequence up will represent wave C and will complete the first 3-leg up of wave A. Ultimately, whether wave A is defined up at this high or at a slightly later high, ultimately the two still dictate that a wave B will most likely follow if the wave count is correct. We need to just go with what we see in price action against the backdrop of this plan. Let's go back to our chart now and see what we are dealing with. What I'm just going to do is I'm going to remove some of the information that we have on this chart so that it just maintains a degree of clarity in terms of what we're seeing. So to go back to what we were looking at, we can clearly see that from a wave structure, we were looking at these turning points. And we saw how this move higher had broken down into a clear 5-wave sequence. We were at about this level when the price action was being analyzed in the previous slide. We can see that the price action moved up towards this point. The question now is this move up here a 3? And if that is the case, then we will likely see prices move lower to a wave 4, and then ultimately moving higher to complete wave 5. That will then complete wave A before we move down to see wave B develop. The bottom of wave B will begin the wave C structure. The other alternative, though, is that this is a wave A. This low is a wave B, and this marks wave C, and then instead we have wave E that potentially has completed itself at this high over here. If that is the case, then this current decline is potentially wave B. Those are the two possibilities. Both support the fact that currently the market is moving down. The one has perhaps a more limited price objective because it is wave 4 of wave 5 before we complete the first A leg up, or the A leg up is already complete, and that then suggests that this decline is likely to be a much deeper decline in price action. Let's now clear all of that artwork and focus our attention on an additional piece of information that might allow us to be persuaded over one, in terms of taking on board one count over another. If we go back to our slide, one final point that I just want to stress is that no matter which strategy or count rather we take on board, both are suggesting that we need to look at buying the dips in the dollar index, because wave B will represent the precursor to a much stronger wave C up. It's always very important, has been one focus of this entire course, for you to look ahead. And once you become familiar with the various tools and techniques in technical analysis, you'll be able to visually identify certain possibilities in price action. Let's take a look at this chart in front of us and see what we might be referring to over here. Now, we can clearly see that we have some turning points that are worth taking note of. First are these two turning points, and we've noticed that the price action has recently stored at a level close to this area of resistance. If we see something along the lines of what we've just drawn in the chart with the two arrows, where we see a pullback and a subsequent move higher, then does that mean we could be in the final stages of a developing inverted head and shoulders pattern? It would take the form of something along the lines of what you have in front of you. If this is indeed the case, that matches up with the wave count that the current pullback is a temporary pullback ahead of a stronger move to the upside. What we can now do is we can monitor price action going forward with the view that this could indeed be the right shoulder of this inverted head and shoulders pattern. If that is indeed the case, then that would lend more weight to wave A, principally because if this move down was wave 4 and then prices moved up to conclude wave A up here, then the pattern of an inverted head and shoulders would not be an argument to take on board, or at least consider at this point in time. So we can come to the conclusion that our focus of attention is going to be on the possibility that we have this inverted head and shoulders reversal pattern. And if that is indeed the case, we will skew our preferred wave count to take in on board the view that the recent high concludes the first of the 3 corrective waves. In other words, the current pullback is a potential B wave setback in price action. Therefore, we can consider a possibility that wherever this pullback stops, as long as it's within reason in terms of the inverted head and shoulder structure, that will represent a wave B. If that is indeed the case, the subsequent recovery could see a sizable move to the upside as part of wave C. Therefore, you now have potentially a much clearer picture in terms of how you will be tackling the underlying view that you have taken on board. You've looked at the more conventional techniques around trend analysis, the trend line, the slope of the moving average, the definition of a trend. We've looked at being able to establish the wave count. We've fine-tuned the wave structure that we're focusing our attention on. We're aware of the Fibonacci retracement levels, and we have a much more rounded, informed overview of the underlying conditions that exist in the market at this point in time. Therefore, we can come to the conclusion at this stage that what we need to look for is an inverted head and shoulders reversal pattern. So if we go back to the chart that we're looking at, we may say to ourselves, okay, we have 2 options. This move down will potentially travel to, just to take a rough estimate, down to these levels. Do I want to get involved in this decline in price action? If I do, that then necessarily means that this perhaps should just be a relatively short-term trading strategy in terms of trading the current move to the downside. You may also come to the conclusion that that is not my preferred strategy at this point in time. I'm much more interested in getting involved in a long position once I believe wave B has run its course. I will look closely to identify an early turning point in the current pullback, because if that is correct, the potential for a move is much more significant and the risk reward opportunity is greater. Not only will that incorporate potentially a wave C environment, but if it does travel higher and we do get the inverted head and shoulders reversal, then that would have a much more meaningful impact in terms of trading a stronger trend and a very significant reversal or a change in market sentiment. So both a long position and a short position can currently be evaluated. If you are looking to trade at the present moment, then you'll be looking to trade a short position because the market is currently experiencing downward pressure. If you say to yourself, I'm going to sit this one out for now because my ultimate goal is to trade a long position as part of wave C and a possible confirmation of the inverted head and shoulders reversal pattern. That means you continue to monitor price action and wait for your opportunity to pounce. And that then is an illustration of how we can come from having very little information in front of us in terms of what you see on the chart right now to a much more complete picture of price action, which then necessarily leads you to be able to evaluate an underlying strategy and then execute that strategy. Remember, the goal for any analyst is to look at planning the trade and then trading that plan. Okay, so what we will do now is we will look at focusing our attention on a real-time outlook in gold. Just as we did with the dollar index, let's evaluate recent developments. what we will see very shortly is that gold for much of this year has been trading in a broad range. That ended recently with the market breaking through the lower end of that range. Let's take a closer look at price action. What I'll do now is we'll just call up a chart on gold, and you can very much clearly see how gold traded following the high in January within a very clearly defined sideways move, having found support and resistance at various intervals within the range, and eventually breaking that range in May of this year. Now, the break of that range is an important technical development because it tells you that the market has or is establishing a much more stronger, committed, bearish outlook. Therefore, we need to consider taking on board a bearish strategy, at least for now, until there's enough reason for us to consider taking a long position. The range or the breakout of the range has to be seen as the most important recent technical development. If we go back to the chart over here, we can clearly see that by identifying the key developments, we can see that the range breakout has identified not a reversal in trend, but a key significant range breakout. If so, we know how we've established this and the conclusions that we can now arrive at. Looking at the chart, there is the range that you're looking at. We see that the breakout occurred at on a specific day in May, and therefore that conclusion with the implications for market sentiment is that the market is bearish. What we can do in terms of applying one of the advantages of a range is that we can calculate the height of the range, and therefore that can allow us to calculate the projection. And we therefore have an idea at least where prices are likely to move to over the coming weeks. As always, you always need to identify where your key risk parameter is. And that level is marked by the most recent resistance. And why that level is regarded as the key resistance is because if we take the decline that ultimately led to the range breakout, we can see that the market has identified a very clear sequence of lower lows and lower highs. In other words, the break below the most recent low in the trend, which happened to coincide with the range breakout, confirmed a resumption of the trend, and that tells you that markets are now likely, if the trend is indeed down, to remain below that resistance point. So by evaluating recent price action, and we've done so in a very different way to what we applied in terms of the techniques that we applied in the illustration on the dollar index, we have, however, followed the same principle by observing price action and extracting the information that we see in front of us. The fact that the markets moved sideways was clear that a range had developed. More recently, in May of this year, we've seen a range breakout to the downside. That then leads us to a bearish conclusion because of the bearish breakout of the range. We can then manipulate some information in terms of taking the information on board with respect to developing and calculating any future strategies by determining where the price action might travel to on the basis of the range breakout. We can identify the height of the range and make a projection as to where, based on the height of the range, where price action is likely to move to. The next key important point is the risk parameter. And we've been able to identify the risk parameter. Now, the risk parameter is also important because if we're going to trade anything against this risk parameter, we need to determine whether our risk reward is favorable against a move down to this level. So, for example, one illustration could be if the market prices traveled higher, you may say to yourself, I'm selling into this rally with my stop loss placed above the key resistance level, and the risk reward is very favorable for that trade opportunity. So very important that you not only know where the market is likely to travel to, but you also have to, more importantly, identify your risk parameter so you can gauge any risk assessment around a trade opportunity before taking that trade on board. So that is our underlying strategy for gold. We're looking for it to move lower. How can we perhaps improve on the overall analysis of the information that we have in front of us? One approach would be to consider taking on board a focus on the intraday price action. Now, one aspect that we looked at in one of the webinars was the combination of the slope of a moving average and as in terms of defining the direction of the trend, as well as then using either overbought signals if the trend is moving down or oversold signals if the trend is moving up as your key timing elements in terms of when to trade. Now, to illustrate that point in this particular example, and this is a 60-minute chart of gold, we can see that at this point here, at this level here, as defined by the vertical lines, the markets were overbought on each occasion. These three elements are important because the slope of the moving average is down. In other words, the trend is down, therefore we're looking for opportunities to sell. This selling opportunity worked well, the market started to move lower. Likewise, this selling opportunity worked well against the overbought reading and price action. In this particular instance, conditions began to change slightly. It didn't really offer a decent selling opportunity. The markets moved sideways, corrected somewhat higher before accelerating the move to the downside. We're not expecting every signal, of course, to work ideally. That's not the case. What we need to see is that whether the overall strategy has some relevance from a trading perspective. And in this instance, the combination of a negative slope with overbought readings and momentum certainly does have relevance. What we can see now, in terms of this chart, is that the slope of the moving average has again reestablished a negative slope. In other words, the question would be, with this sharp sell-off in price, and notice that this sell-off marked the breakout of the range, we can ask ourselves whether the market is likely to establish a more concerted and a clear directional move to the downside. If that is the case, what we will do is we'll wait for our overbought reading to be confirmed before we then execute a sell in this particular instrument. So that would be perhaps a strategy and a plan that you can take on board. So one option would then be to consider looking at applying a return move structure to price action. We've seen how the overbought and the negative sloping average of the or the negative slope of the moving average has been effectively used to identify selling opportunities. Again, as I stressed earlier, the slope of the moving average is negative. What we could perhaps consider then is trading the return move opportunity if this presents itself. So something along the lines of what you see in front of you. Now, if we go back to the chart, the return move is something that we did indeed see. Markets move from these lows back to the breakout point, and I'd just like to spend a minute to discuss what the return move is. You may recall that when we discussed this in one of the webinars, a return move is something where the market will come back to test a significant break to further validate the importance of that break. So what we've had in this instance is we've had a break of a number of key support levels, which has represented a range breakout. The markets tend to come back to test these levels to see whether they act as resistance. And if that does then subsequently act as resistance, or those levels and the market travels downward, re-establishing the downtrend, then the conclusion is that that further reinforces the significance, in this instance, the bearish significance of the break of the range. So that again is a forward-thinking approach in terms of how we can consider trading a market if we do see certain developments in price action. If we take a look, however, at the hourly chart, and in the slide that we were just focusing our attention on, This is the range breakout. We saw how the market did establish a negative slope in the moving average. And unfortunately, though, we haven't seen up until now a clear directional move in price action to the downside. We've seen a low at this level, the market reacting up to these highs over here, and this was the return move that we just discussed. We are seeing price action perhaps trying to establish a downtrend, and our latest observation is that the moving average does seem to have once again adopted a negative slope. We may say to ourselves, okay, we'll keep a close eye on this one because clearly we haven't really established any kind of a downtrend. What we need to see is the market having established a sequence of lower lows and lower highs before really beginning to consider a trading opportunity in price action. So you may then come to the conclusion and say to yourself, okay, instead of looking to preempt any move, what I will do is I'll look and wait for the markets to trade through these lows. Certainly if the slope of the moving average is still negative, then I will wait for any subsequent overbought readings and price action to consider establishing a short trade. So that is just one illustration in terms of how you can apply an intraday chart to fine-tune your entry points. If your preference, on the other hand, was just simply to look at using the daily chart, then your observations have been that, yes, we've had the range breakout, we've had our return move, the market is attempting to pull back. What we may decide to do in this instance is wait for the break below these lows to confirm an additional sequence of lower lows and lower highs, which would then confirm a resumption of the downtrend, and we would then have this parameter that we could use as our risk parameter against a objective down to this level. If you were a more aggressive trader, we had this as our key risk parameter, whether or not you decided to sell into this pullback against a stop loss level up here. Also would have been a feasible consideration, given that if you are correct and the market travels down to these lows, the risk reward is certainly favorable from a trading perspective. So you can clearly see how technical analysis, once you've become familiar with the various tools, techniques, and the approaches in terms of how they're applied, can give you a very strong insight into getting to grips with the underlying conditions in the market, establishing what conditions are relevant at this point in time, because those are the ones that you'll be taking on board to perhaps formulate your decisions. And you've gone a long way in terms of getting yourself to a point in a disciplined and objective manner to making a final decision around a particular trade. Always remember that once you've made these decisions on a technical basis, if that is your preference, focus on the fundamental issues that are driving the market in terms of what bearing this has on the underlying technical condition as well. By employing both fundamentals and technicals, you have a much more informed overview of the market. In theory, that should place you in a much stronger position, both in terms of the decisions that you'll make and also how you will manage those decisions once they've been made. That brings us to the end of today's webinar. What we try to apply in terms of the workshop was to illustrate how you can incorporate technical analysis into a solid trading plan, applying robust skills that are necessary to read markets, and we had some final thoughts just in terms of certain aspects of the topics that we looked at today. This brings us to the end of the Advanced Technical Analysis course. There is, however, one additional bonus webinar that you will be able to access, and this is an introduction to advanced theory. It's a teaser, so to speak, of some additional applications that haven't been looked at in the Advanced Technical Analysis course. And this webinar introduces you to the foundations of seasonality around volatility, an introduction to who Gann and Gartley were and their contributions to technical analysis. There's also an introduction to speculative positioning. We look at the differences between the institutional and the retail trader, as well as what institutional and retail positioning is all about, the COT indicator, and also an introduction to relational volume divergence approach. Congratulations, everybody. You've now finished both webinar 12 of the Advanced Technical Analysis course, as well as the entire Advanced Technical Analysis course. This has been the end of course workshop. It concludes the Advanced Technical Analysis course. We'd like to thank you for joining us, and we look forward to seeing you next time. Bye for now.